Hello everyone. I will continue with the remaining part of chapter 11 in this lecture. So we start with different measures of yield and return. So there are different measures which help us to understand the rate of return earned during the holding period. So we start with current. Current yield is the uh, amount of current income relative to the market price. So in this case, we take the annual interest income and divide it by the current market price of the bond. So that gives us the current yield. It is simple, but it only looks at one source of return, it is annual interest income. The next measure is yield to maturity. This is a very frequently used measure. So it looks at the rate of return for an investor who holds the bond to maturity and receives all principal and interest payments during the term to maturity. So it is basically the internal rate of return on the bond. So we have the bond which pays 7.5% interest per annum. It is available at $1,000 par value, that is $1,000 is the principal limit, and 15 years remain to maturity. So what is the current market price of that bond? So, or rather, we know the current market price of the bond. So using this set of information, we can find the yield to maturity, the internal rate of return. So from the financial calculator or from Excel, we can find that in this case, the yield to maturity is 10%. If it is semi-annual compounding, so we have twice the number of interest payments. The coupon becomes half, and we assume similar market price. Based on that, we find the semi-annual yield and multiply it by 2 to get the yield to maturity, or the bond equivalent, what is known as bond equivalent. We also look at the yield to maturity for a zero coupon. So there is a sale price and there is a price at maturity. So the price, so we divide the price of maturity by the sale price, and using that we can find the yield to maturity for a zero coupon. We can also do it through financial calculator or Excel. If we assume if we assume annual compounding, we use one set of formula. If we assume semi-annual compounding, we find the bond equivalent yield with a different formula, similar formula. We also have yield to call. So this is the measure of the expected return from a callable bond. So in this case, we do not consider the term to maturity. We consider the period from present to the first call date. And we don't use the par value or the principal amount, we use the bond's call price. And using these two new set of information, we can find the internal rate of return of the bond, which we call the yield to call. For example, in this case, a 10.5% deferred call bond, which can be called after 5 years, and the call price will be 1085. So we use this information to find the current bond. We may have the current market price, and using this information, we can find the yield to call for this particular bond. Then we have expected return. Expected return is important for investors who will not hold the bond till maturity. So yield to maturity is not important for them. Rather, they look at expected return, which is also called the realized yield. So in this case, we again discount the future cash flows using the current market yield, and we have to estimate the market price at the time of sale in future. So that becomes a bit subjective and that may not always be accurate. And hence the realized yield may also not be accurate. But that is the process for finding the expected return. So for example, this case, 7.5% annual interest, current market price is 809.5. And after 3 years, we expect the market price for the bond to be 960. So based on that, what is the bond equivalent? We can find out using the formula given in this slide. So what are the key considerations when looking at bond valuation? So for conservative risk-averse investors, they focus on the yield to maturity because they want to earn uh, interest income at regular intervals and they want to hold the bond for an extended period of time. For aggressive traders, they want to profit from the changes in market interest rate. So they focus more on the expected return because they want to earn capital gains by frequent trading. So their holding period is brief and hence they focus on the expected return for the holding. Now we look at duration and immunization. So what is duration? Duration is a measure of bond price volatility. In this case, we consider both price risk as well as reinvestment risk. So this is better than yield to maturity, which is also an important criteria for bonds because it only looks at the price risk. So what is duration? The duration means the average time required for the cash flows of people. A bond may have cash flows at regular intervals. So we find the present value of those cash flows and we find the average time in which we can expect the cash flows to happen. And we generally see that bonds which pay higher interest have shorter durations. Bonds which have higher maturity have longer duration. And bonds which have higher yield to maturity, they also have shorter duration. And why is this important? Because any bond which has shorter duration will have less price volatility. So the price will change less in response to the same changes in interest rates. So how do we measure bond duration? As I said, it is the average amount of time to receive the interest on the capital. And it is calculated the weighted average of the cash flows discounted to the present time. So what are the steps involved? So we have different coupon payments and the final principal payment. So we discount different payments with the prevailing yield to maturity. Then we divide each present value of cash flow by the market price of the bond. So we get the weight, then we multiply the weight with the year in which the cash flow happens, or maybe the semi-annual period in which cash flow happens. And then we add up all the weighted years. So that gives us the bond duration. So in this case, 7.5% annual coupon, 15-year maturity, and yield is 8%. So we get the annual cash flow, we discount it by the 8% yield, and then we multiply it by the time at which the cash flow happened, year 1, 2, 3, and so on. And then we add the time weighted present value of cash flow. Then we get the duration as 9.36. So one thing that we need to keep in mind, the duration of any bond will change over time because the yield to maturity will change, the term to maturity will also change. So accordingly, the bond duration will also change. And if we are looking at a portfolio of bonds, then the duration of the portfolio is the weighted average of the bond portfolio of the respective bonds. We have the duration of each bond, and the weights assigned is percentage contribution of each bond to the portfolio. So why do we consider bond duration? Because it helps us to understand the change in prices due to the change in market interest rates. Especially if the interest rate changes are small, then we can assume that the bond prices change in a linear fashion. So to find the change in bond price, we use a different measure called modified duration. Modified duration is the Macaulay duration that we discussed in the previous slides, divided by 1 plus yield to maturity. If we use the modified duration along with the change in interest rates, so we will get the percentage change in bond price. So we can calculate the duration for a bond, we can calculate the modified duration, and if we know the change in interest rates, provided it is of small amount, then we can predict the percentage change in bond price, assuming linear relationship between interest rate changes and changes in bond price. We also have something called effective duration. So this is an alternate measure. It is used for bonds which may be called or which may be converted into equity. So for special type of bonds, we have this effective duration. So what is the utility of bond duration? So one is immunization. Because bond duration considers both price risk as well as reinvestment risk. What happens is when interest rate changes, in some cases, the price of the bond will go down, but reinvestment opportunity will go up because market interest rates have gone up. So the reinvestment risk and the price risk are in opposite direction and they cancel each other. Bond immunization happens when average duration of the bond portfolio or the duration of the single bond is same as the investment horizon. So in this case, even if the interest rate fluctuates, the price risk and the reinvestment risk cancel each other equally, and the returns from the bond are protected. So that is why it's called immunization. So this is an example from the textbook. A bond which is held for 8 years, 8% coupon rate, 8% annual coupon rate, and $1,000 is the par value. So after 5 years, the interest rate drops to 6%. So what happens is par value, the bond price increases, but the reinvestment risk also increases. So both of them cancel, and what we notice is that due to immunization, that is reinvesting the cash flow at lower interest rate plus increase in bond price, both of them cancel each other and the required return is ensured. If you see, if there was no change in interest rate, the investor would have earned 1850.93. Using the immunization technique, the total return is 1850.3. It's almost equal. So that is how the returns are preserved. So if we have a portfolio of, so in this case, it is a single bond. So cash flow is coming reinvested at a lower interest rate, but at the same time, the bond price has. But if it is a portfolio of bonds, then we may need some kind of rebalancing, selling some bonds, buying new bonds, so that average duration is the same and required returns are present. So now we look at some of the investment strategies. Passive strategy, trading on interest rate trends and bond swaps. Passive strategy means the investor does not have significant transaction costs because they don't trade that often. So one is buy and hold. So I will buy a bond, hold it to maturity, I'll get the money back, and then I invest in another bond. So one special category is bond ladder. So in this case, I can invest in multiple bonds of different term to maturity. As a bond matures, I will take the proceeds and invest in a 10-year maturity bond. So that way, this current ladder of term to maturity is maintained, that it gets staggered by 10 years. The next strategy is trading on interest rate trends. So in this case, the investor would trade frequently and they want to increase the return on their bond portfolio. So if they expect the interest rate to decline, so they will want to achieve more capital gains. To do that, they will buy more longer duration bonds. So they are more sensitive to interest rate changes. Interest rate declines and there is a larger increase in the bond price. Similarly, when they anticipate interest rates to increase, they will invest more in shorter duration bonds. The bond price will change less due to the change in interest rates. The bond price will decline less due to the change in interest. So they are active traders. They hope to earn more capital gains by looking at the interest rate trends, and hence they use bond duration as a way to increase their returns. The next strategy is bond swap. So in this case, an investor will sell one bond and simultaneously buy another. So they may want to increase the current yield, they may want to ensure tax benefits, and so on. The first one is yield pickup swap. So the investor will sell a low coupon bond and buy a comparable higher coupon bond. So this way they are able to increase their yield. Or increase their yield to maturity. The only thing they should be careful about transaction costs, because you are buying and selling at the same time, so there are costs involved. And then we can also have tax swap. So the bond has declined in value, so I sell that bond to achieve capital loss, to realize capital loss, and that I can offset against any other capital gains in my investment portfolio. And with the proceeds of the sale, I can buy another bond of comparable credit quality. The only caveat is that I cannot buy a bond identical to the previous bond. So in that case, I cannot have the tax benefit of offsetting capital loss with capital gains. So I have to buy a bond of a different issue. So then only I can do simultaneous trading and take the advantage of tax swap. So that's all for chapter 11. I'll end here. Thank you.